Good morning. It's 10:53 a.m. 6/13/2011 weekly chart. The blue line crosses over the red line. If we get one more week closing below it, it'll be four. You got to have 4 weeks below the blue line. That's the 10-week simple moving average. 4 closing weeks below it turns this bull rally on the S&P into a bear. And the thing about it is, from that top to this reversal, this was your bull rally. But now your bull rally broke the neckline. We were shorting this rally up here at the highs. Go look on our website. Now you can see that this neckline was broke. You can also see clearly here that the blue line is a 10-week simple moving average MMTs. And when you cross over it, your next support level MMTs is right here. That's the pink line, 50-week moving average. Right over here where we broke the double tops. That's the lower support level. This is the first yearly low. And we're weak. But remember, MMTs, when we were putting this low in here, we got right back above the 10-week. We're not. The further mathematically that you pull below it, the weaker that the S&P will be. And that 4 closing weeks below it is considered a bear reversal, not a bull reversal. It goes into a bear reversal. Until that day of getting back above these key weekly moving averages with 4 closing weeks below it is no longer a bull rally. The bull rally has turned into a bear reversal instead of a bull reversal. There are differences between bull reversals make higher highs all the way up to here. Okay? And all your weekly moving averages are going up the hill. And that's where the hedge fund managers, everyone buy. Now, let me caution you something. It's an options expiration week, so, nothing has to make sense in the current price level. But I can tell you that the S&P 500 earnings, that's 500 companies, all 500 companies in the S&P 500 are going into July reporting earnings. And MMTs at $95 across the board, and those earnings are, the S&P is not sustainable at these high levels right now up here where it was. This was totally inflated earnings of the broader S&P 500 here. And that at $95 a share on the earnings, the growth in the S&P 500 doesn't reflect $95 of earnings on fundamentals across the board, not in my view. And it's all because of that is why you're seeing the big reversal from bull rally turning into potentially bear reversal now, is that these things happen. And they happen this way. So there's a technical thing that happens, but then there's a fundamental thing that happens. And we've done excellent in the S&P 500 for over the last 2 years. Ever since we had the big bull rally over here. That's this bottom here in the S&P. That's when the earnings were cheap. And we've had a couple of year movement in this S&P. And we had the earnings that were very cheap earnings reflected this long bull rally up to 2010 with the pullback in another 2011. Now the earnings are retail to the S&P 500 forward looking in my view. Otherwise you wouldn't about to be cross over here and go into a bear signal versus the bull rally where you keep making higher highs all the time, because that's not the case. And the case of it is that we're going to get earnings warning season coming in a couple more weeks. So we're going to take a look throughout the whole month of July as we go through the bulk of the S&P 500 earnings as how many come in line, how many guide down, and how many people contribute to whatever they contribute to. I just contribute to wholesale value and technicals. That's all we do. That's what works. The other thing of it is that with the lower GDP and all this stuff about second half is that the S&P is trying to price in these lower earnings from that bull reversal to potentially from a bull reversal rally to a bull reversal that turns into a bear. We have the qualifier and MMTs For the new ones in the school, go to the homepage. Look at when we said that the big reversal and big overbought markets were coming, and they certainly have lived up to their expectations. An extremely exuberant bull run that now has gotten quite sloppy. And we called the tops and time to sell. And all that evidence live before the effect analysis happens to be on your lovely stockmarketfunding.com index page. And if I were you, I would go start there and get a grip, because that's what it's about. Now, granted that we're not 4 weeks below it yet, but we're headed that way. And you're 1 week, 2 weeks, this is the third week. You have to get back up above it for it not to be in that. The upside resistance will be a challenge here whenever it does get here and we do get a reversal from short-term oversold. But nonetheless, let's take a look at some of the weekly public indicators. One of the key factors on this weekly chart is if we go into what we call a weekly sell signal. We're not there, but you can see that this is going down in value. And when this goes down in value, then markets go down in value. When these go up in value, markets go up in value. And that's what brings a bigger money into the market. Just remember that the 200-week moving average is way down here. There's a 50-week moving average pit stop right here, this lower trend line. This is the all-time low in the S&P right here in calendar 2011. And we said you could put in another good bull rally, but then it would get so overbought that you had to do what's happening now.